It's a battle of the world's largest crypto exchanges, Binance and FTX. To find out why FTX token FTT dropped 10% overnight, and in breaking news another 10% just now, watch today's Liquid Gold crypto news. Will this crypto crash lead to another 2008-like financial crash like Luna did earlier this year? I'm your host Rob Blasetti, let's find out. The price of FTT dropped 10% as Binance CEO CZ announced that they are dumping their holdings in an effort to de-risk from the crypto markets after the Luna crash. It has sent 3 Arrows capital-sized concerns through the crypto industry as the announcement was made after what CZ calls recent revelations that have come to light. For those who weren't in crypto earlier this year, the 3 Arrows capital contagion was a 2008 financial crisis-like event where the stablecoin Luna lost its peg and took down a big chunk of the crypto industry. Even though CZ cautioned that this is not a move against a competitor, it does kind of seem like a direct move against a competitor. Speculation has risen that this could be in response to the recent regulatory proposals from FTX CEO Sam Bankman-Fried around DeFi regulation, the revelations that have come to light. Though it's more likely that, as CZ says, this is just risk management on behalf of Binance after the recent Luna stablecoin collapse. FTT is the FTX token that's issued from FTX for a discount on their trading fee. This also helps keep exchange users in the FTX environment, so it's necessarily a competitive token for Binance. The data shows that the market for FTT is highly illiquid and mostly held by a few wallets. Let's define some of the terms and set some context. FTX is the second largest crypto exchange in the world behind Binance. FTX is run by Sam Bankman-Fried, SBF, who also runs a trading firm called Alameda Research. Binance, the second largest exchange, is run by Changpeng Zhao, CZ, and they were the ones that made the move to liquidate 23 million FTT tokens they're holding. The balance sheet of Alameda Research, SBF's trading firm, was leaked by CoinDesk, showing that they have 14.6 billion in assets against 8 billion in liabilities. A significant portion of their assets, around 5 billion, is made up of FTT and FTT collateral, and a lot of illiquid altcoins. So what does this mean? If most of the FTT is held by FTX and Binance is selling their portion, the market could sink fast. Given many of their altcoin holdings are illiquid, they won't necessarily be able to sell them to pay off any debt, and the situation is looking like a ticking time bomb. Here's some context around the FTT token. Alameda reportedly holds 5.82 billion in FTT, and the current FTT market cap is around 3.35 billion. Not good. 99% of the tokens is held by 1% of the addresses, which include Alameda Research, whose VC arm merged with FTX. Not good. This shows the business is high risk, and one small incident could set off another 3AC style contagion event. Why? Alameda also had debt to Voyager, one of the problem businesses in the 3AC contagion event, to the tune of around 370 million. If they have to write off this debt, Voyager could tip over too. What do you think of this event? Will it trigger another 3AC style contagion, or is this just the completion of that contagion which left the industry pretty weak and wounded? Leave a comment down below, hit the like button, and subscribe for more daily crypto news content. Solana held their Breakpoint conference from the 4th to 7th of November, where they made significant announcements. One of them was more information around the Solana phone, which is available for pre-order in early 2023. It was first announced in June along with the Solana Mobile Stack software kit. It's a Web3 first phone. This phone has a seed vault, a solution for custodying crypto. The phone is built and waiting for final software approval now. This is great for handling your crypto investments. For example, if your investment changes, the phone could notify you directly if the keys are baked into the hardware. Users won't have to sign in with many different applications to use their crypto. It'll be all baked into the phone. It's worth noting that this phone is not intended to compete with Apple or Google in terms of huge sales figures. It's a developer first phone intended to attract developers to the platform and build out the Web3 ecosystem mobile first. Separately, the phone will allow users to create digital content and have digital ownership without having to give Apple or Google their very controversial 30% cut. The 30% cut is a direct hindrance to the success of Web3 because users can't make a profit with that kind of tax. Solana isn't the only Web3 company building their own phone. Polygon also announced an upcoming Nothing phone, partnering with the phone maker brand Nothing. If nothing else, these phones will at least apply some sort of pressure to the industry giants to make them attempt to integrate Web3. In the coming years, they could start to eat away at the phone market little by little, or at least they could have a lasting effect on the way that Apple and Google apply their NFT taxes or any other Web3 taxes. The CEO of Solana-based NFT marketplace Magic Eden is pushing for a new NFT standard with creator royalties baked in, calling it a new asset class. This is in response to recent data that suggested that their market share is quickly falling as trading platforms that reject creator royalties are gaining in popularity. Magic Eden until now has enforced creator royalties, but it's making a shift to not honor this anymore due to the erosion of their market share. Obviously, traders would like to pay less in royalties to make the most profits, which is showing up in this data. The change would allow for a new kind of business model that gives creators creators sustainable income, and this is important to give creators some sort of level of control over their art. The trade-off is that the holders will need to give up some level of control or freedom, or freehold ownership of these NFTs in favor of the creator. Most blockchains do not protect creator royalties at the blockchain level. This could be a point of difference that helps Solana thrive. Raising the standards for creators is a push against the stream. I think Jack Liu is correct that these rules need to be baked in on a blockchain level to help enforce a healthier industry standard. If we want creators to make quality content and continue to do what they do best, they need to be protected at the blockchain level. Businesses will cave to the market, and the market will lower their standard because most people want a good deal, which has an inverse relationship with rewarding quality. It could be possible that as the industry matures, the market will also mature and find an ethic in rewarding the creators. It's possible that we are just too early and we don't need to rashly make changes to blockchain rules to push change in the market. What do you think? Should we bake these rules in at the blockchain level, or is the market just a bit too immature right now? We need to wait. Leave a comment below. Hit the like button and subscribe for more daily crypto news content. That's all for today. If you made it this long, thanks for supporting, and I'll see you tomorrow for more daily crypto news.